Hey everyone, this is Logan Hertz with Hazeltine. We are now going into part 3 of our cash flow optimization exercise, where we're going to start reviewing some of these solutions that we did for John Smith in detail. But just to recap part 2, we've now covered John. At first, we saved him $24,000 a year by optimizing his current cash flow situation, optimizing some of what he's spending, and so on. And then we went through and covered all of his bases, both for protection and started saving, right? So this is just kind of a recap of part 2. So in part 3, what we're going to do is we're going to start going into the solutions that we developed for him in a bit more detail. And we're going to start with the disability income policy. So let's take a look at this. So this is a sample disability income policy. Of course, there are many we could do. This is with the standard. I can work with multiple different carriers. Uh, I personally, what I specialize in is infinite banking. So when I put together a comprehensive plan and do something like a disability plan, I work with other partners who are experts in disability income, and they can do things like review your current disability policy if you have one individually owned or through an employer, take a look at it and help you to understand exactly what it's giving you, because sometimes these contracts can be a little bit confusing, and we can help clarify what's covered, what's not covered, what are the benefits, what are the limitations, etc., especially with an employer provided plan, because most people don't really look into the details of what are the limitations of that employer provided plan. So this is a very robust, individually owned disability income insurance policy. Let's take a look. And this is the summary, which we're going to go into. So John Smith makes $150,000 a year. He's a 35-year-old non-smoker, okay? And he works in sort of a very white-collar desk job type profession. And you can see here the base policy annual premium is about $1,500, okay? Now, the basic monthly benefit is $7,220, okay? That is about 60% of his gross annual income, and that is typically what your disability income policy will cover. It is tax-free, okay? So it's not going to get you fully, it's not going to cover all of your income, but partly it's discounted because, again, your income is taxable, whereas this, because it's an insurance benefit, is tax-free. Okay. The benefit waiting period is 90 days. That means once you have some kind of a disability and you lose your income, you have to wait 90 days until you can start collecting benefits from this policy, because, again, this is intended to cover long-term disability, not short-term disability. And it's payable to age 67. So if you were to go on claim, as long as you still were unable to work and generate an income, you continue to collect benefits all the way to age 67. So pretty much covers all of your working years, okay? These features here are included in the base policy. I'll highlight a couple of things. The family care benefit, this actually allows you to collect benefits if you need to stay at home to take care of a sick family member. Could be a spouse or a child, even potentially a parent. That is a benefit that, as far as I know, is unique to the standard. That's a pretty nice benefit. So not only if something happens to you, but if something happens to a family member and you need to stay home and take care of them, that you can collect on this policy. Also, it covers mental disorder or substance abuse unlimited. So if you were to have some of those problems and be unable to work as a result, this policy would cover you. Okay, now let's look at the riders here. Own occupation, I think, is very important, especially depending upon your occupation. Okay, what this does is this means that you can collect a benefit if you're unable to work in your current occupation, but maybe you are able to work in a different occupation. Okay, disability policies typically require you to be unable to work, period, right? Whereas here, let's say you are I'll give you a real life example of a dentist. Okay, he was a dentist, and like most medical professionals, he had fairly robust disability, individually owned disability income insurance. And he developed a tremor in his hands, such that he did not have the dexterity to be a dentist anymore. Okay, and so he collected on his disability policy. Meanwhile, he got a new job teaching, right? So he now teaches dentistry students in the classroom, which he's still able to do. Meanwhile, he can still collect his full disability benefit because he had the own occupation rider. Okay. If he didn't have the own occupation rider, what would happen is as soon as you're earning income, well, then you can't collect anymore, right? Because this policy covers you for loss of income. Okay. Residual disability. This is important too. This covers you for a partial loss of income. Okay. And by the way, most claims are actually residual. Oftentimes it's just a partial and not a total loss of income. Maybe he's still able to work, but in a more limited capacity. And as a result, his income takes a dive, suffers a dip, right? This policy will make up for the difference if you lose at least 20% of your income. Non-cancelable, also very important. Non-cancelable rider protects your insurability. Okay. This means not only can the insurance company not cancel the policy, they cannot raise the rate. So he's 35 years old. He's locked in at his current rate, no matter what happens to his health, and no matter how old he gets, up to age 67, he can continue to keep the policy in force. They cannot cancel the policy on him. Okay. And they cannot raise the rate. They'll be paying the same rate at age 60 that he is today at age 35. Indexed cost of living. What this means is that if he goes on claim, and if that claim lasts for more than 12 months, then the benefit amount is indexed to inflation. So it goes up, capped at a 6% maximum increase. So if you are on claim for multiple years, this would protect you from seeing your benefit eroded by inflation. Okay. Catastrophic disability covers the remainder of your income. Remember, this base policy covers 60% of your gross annual income. So scrolling back up, that's $7,220 a month. This, if he is catastrophically disabled, would cover him for the remainder of his income. So it would actually cover 100% of his gross annual income if he is considered to be catastrophically disabled. And then this is a student loan rider. So if you have student loans outstanding, okay, what this will do is it will cover that student loan payment. It will simply add an additional, in this case, $1,500 a month for 15 years, okay, to help you make those student loan payments. There are also some disability policies that will cover you for retirement contributions as well. So if you're making contributions to a retirement plan, and especially if that contribution is matched by an employer, there are also riders that will cover that contribution as well. So not only will it cover your income, it will also give you what you plan to contribute to retirement. So your income comes in uninterrupted and your retirement plan continues uninterrupted as well. These last two, again, are part of locking in your insurability, the benefit increase rider and the automatic increase benefit rider. So the automatic increase means your benefit amount goes up 4% per year automatically. Okay. That's important, obviously. And then the benefit increase rider means that at certain intervals, in this case, once every 3 years, you can increase the benefit amount with no underwriting. So every 3 years, you can then get a more substantial increase. Hopefully over time, you're getting promotions, you're getting raises, or your business is growing, and therefore you have more income. And so you need more coverage. This allows you, again, to get that increase with no underwriting, right? No matter what has happened to your health, you can continue to get the coverage you need as your income goes up over time. Okay, so again, it's so important that this policy be non-cancelable, that you individually own it, and that you have these riders so you know you can always get the coverage that you need no matter what happens to your health, no matter your age, up to a certain point, as long as you're in what they consider to be your working years. Okay, if you're 80 years old, that might be a problem. Okay, but if you're 60, no problem. Okay, let's scroll down a bit. Here you can see, again, just here verbally on the left, you can see they're kind of explaining what I'm telling you, right? So non-cancelable, I want to highlight that one. They cannot change your policy or raise the premium, okay? No matter what, right? Your health could be really bad. Doesn't matter. They underwrote you already. You locked in your current health and age. Okay. And then this just kind of gives a summary. So the summarizing everything that we have on the policy comes to an annual premium of just under $3,000. Or if you were to pay it monthly, it'd be about $261 a month. So in John's case, it's about 2% of his gross annual income. And as a rough rule of thumb, this is about what you should expect. You should expect to pay, again, I'm making a blanket statement here, 1% of whatever asset you're protecting per year in order to insure it, just as a general rule of thumb. In this case, because we're getting very robust coverage, it's more like 2%. Okay. So he makes $150,000 a year. He's paying roughly 2% of his gross annual income to get very good, robust, individually owned disability income insurance. Keep in mind, this rate is locked in, does not go up. Okay. No matter his age or health. Let's scroll down a little bit more and see some of the options that we have. So this grid here gives you a good overview for how you might adjust coverage. Okay. What we have chosen here is the scenario that I typically think works for most people. So we have a 90-day benefit waiting period, meaning we suffer some illness. Okay. We're unable to work and we stop receiving income. Okay. And then we have to wait 90 days before we can start collecting the benefit. We could make that waiting period shorter or longer. And you can see, obviously, if you go with a shorter benefit waiting period, it's more expensive. If we go with a longer benefit waiting period, let's say 6 months, 180 days, then it becomes cheaper. And then, of course, we can adjust the time frame as well. But I typically want to go all the way out to age 67, right? Most people are working longer. Most people are working well into their 70s. Maybe they're working in a more limited capacity, but they're still working. It would be nice to still continue to receive, to still have your income covered, okay, all the way to age 67, and you're locking in your insurability. And of course, at any point in time, you could drop this coverage. I wouldn't recommend it, but you're not locking yourself in the sense that you can always decide you don't want the policy at some point in the future. So if you become a mega millionaire at age 50 and you decide you don't need this anymore, well, no problem. You're not promising to pay premiums to age 67. You can drop the coverage. And you can see here there are obviously other options as well, 2, 5, and 10 years and so on. But in general, I want you to lock in your insurability for all of your working years, right? The sooner you do it, the cheaper it's going to be in the long run, right? Proper financial planning requires long range thinking. The longer the time frame we lock in our insurability, the better. And that's going to be the cheapest for us over the long run. Okay. If we lock it in temporarily, then we have to go at some point in the future and apply again when this expires. It's going to be more expensive because we're older and maybe we're not insurable, or maybe we have some health issues such that we're insurable at a higher rate. Okay. So we have to think long range. Okay. Let's see if there's anything else here I wanted to show. There was, I believe. So this just shows you a potential $4.8 million of benefits. That's in the worst case scenario if he were to go on claim, tomorrow and collect this benefits. But I think that number is important to see, right? Look at what you're protecting, right? That's what you're actually protecting. Your income from now until the day you retire, right? If you'd have some catastrophic health event happen to you in your early years, this is the loss to you, 4.8 million, right? You want to protect yourself against a potentially catastrophic loss. Offense wins games, defense wins championships, and an ounce of prevention is worth a pound of cure. Plus the psychological just peace of mind of knowing that this is just one more thing you do not have to worry about. Okay. There was something else I want to check because I believe you can keep this policy in force all the way to age 75. Okay, and this is showing you some of the included benefits, right? So we mentioned the family care benefit that's unique to the standard. I think that's important to highlight. One other thing to look at here that I think is interesting is most people, when they think of disability, they think of you get into a car accident, you suffer some kind of injury. That's actually not what happens in 90% of cases, right? In 90% of cases, it's actually an illness, like as an example, cancer, right? I have a friend who was in his mid 40s and seemed healthy, and all of a sudden he got a cancer diagnosis, right? And he was able to recover because he was otherwise healthy. It ended up being not too bad, okay, but he had to shut his business down for a significant period of time while he got treatment, right? And so he was receiving no income. Thankfully, I believe he did have some kind of disability coverage, so he was able to get covered for that time frame. Okay, but that's just something to keep in mind, right? The likelihood of you getting into an accident and having some kind of disability may be relatively low. But again, if you're 35 years old, what do you think is the likelihood you might potentially get diagnosed with cancer at some point between age 35 and age 67? It's a bit higher if you think about it, right? So let's see. Yeah, and the premiums are waived while you're receiving benefits. And there was one more thing I wanted to check because I do believe, yeah, we'll get there. So again, this goes through age 67, but I think you can keep the policy in force all the way to age 75 in a limited capacity, which is actually really important to know because again, I think most people are working later in life. So it's good to know that this same policy will protect you all the way to age 75. Okay. I don't see it in here, but I will go back up. I believe the way that works is so this policy will stay in force to age 67 as long as you pay your premiums. Okay. No matter what happens to your health, no matter how many times you use the policy stays in force and the premiums do not go up all the way to age 67. Pretty important. So you've locked in your insurability at your current age and health. In addition, once you get to age 67, my understanding is you can still keep the policy in force without going through underwriting all the way to age 75. What will happen is then the premium amount will reset based on your age, not based on your health, right? So no matter how many bouts with cancer you've had, no matter how unhealthy you are, you can still keep the policy in force, okay? And all of the riders will fall off, meaning now it will be just the basic monthly benefit, okay? And your premium will go up based on your age. So you'll be paying the rate of a 68-year-old, okay, but a healthy 68-year-old. And benefit amount is limited to 2 years. So if you go on claim, it's capped at 2 years. Okay, so again, this is very important. This is a very robust, individually owned disability insurance policy that protects you against any loss of income, and it protects you in some capacity all the way to age 75, right? And it locks in your insurability at your current age and health. So for all those reasons, I think this is a very good policy. It's very important. And this is the first of what we did for John to set up his defense, set up his protection. Okay. So that I think is it for this particular policy. And we will continue going through the policies we've got on John in our next few videos. Thanks for watching.